Welcome to the Meb Faber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Meb Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
Welcome back, everybody. We have another episode, a mebisode we wrote called The Bear Market and Diversification. We got to start with a quote from one of our favorite professors, Aswath Damodaran, and he says, "Investing goes off track when you believe you are entitled to high returns because you did all the right things." Let's get started. But first, a warning. If you're an investor, or even worse, a financial advisor, and you have a globally diversified portfolio, you may want to stop listening now. Continuing may just be too painful. We should form a support group for investors who built low-cost, tax-efficient, globally diversified portfolios across stocks, bonds, real assets. These investors rebalanced their portfolios and didn't waver when COVID hit the fan. And despite all that well-researched and thoughtful implementation, they got steamrolled by the S&P 500. The following phrases may bring out some PTSD, or maybe a better acronym would be GAASD for Global Asset Allocation Stress Disorder. Raise your hand if you muttered any of the following phrases to yourself, or for the financial advisors out there, if you heard any of these phrases, this list is probably just the beginning. Can you explain why we own foreign stocks? All they do is underperform. China's down 60%. Or how about, why do we hold gold? Okay, boomer. Or maybe, everyone knew investing in bonds at 1% was a dumb idea. Why didn't you? Or, I read recently that GDP was going to accelerate 50% a year due to AI. Can we sell all these underperforming value funds and just buy QQQ and NVDA for NVIDIA? Or maybe lastly, this portfolio is way more volatile than my neighbor's. He's in private equity and real estate, which moves way less. Okay, that's enough. I could go on, but it would be just cruel. You know all this because you lived through the bear market and diversification. What exactly do I mean by that? Back in 2015, I wrote a book called Global Asset Allocation, a survey of the world's top asset allocation strategies. The book examined various asset allocation portfolios and their performance from 1973 to 2013. While most of the portfolios had returns similar to those of U.S. stock market, they also featured lower volatility, lower drawdowns, and a higher Sharpe ratio than just sitting in the S&P 500. It didn't matter what specific allocation was chosen. They all did a pretty good job smoothing out the rocky ride that was the U.S. stock market. So let's say you read the book, you decided to invest with a global asset allocation model as your guide. Things got tough. Actually, the tough times really began in the aftermath of the global financial crisis. Stocks declined by over 50% during the GFC, causing many investors to panic and capitulate. The most bearish readings ever on the AAII survey occurred at the bottom in March 2009. For many years after the GFC, we spoke to investors who proclaimed, "I couldn't take any more. I sold everything. I'm still in cash and just too scared to get back in." Unfortunately for these shell-shocked investors, stocks have ripped since March 2009, compounding at 15% per year through 2023. Let's examine how various asset allocation strategies perform from 2009 to 2023, and we'll use the end of 2008 for simplicity. The exact allocations are in this free ebook, Global Asset Allocation, free to download online. As you already know, the S&P mowed down everything. Whether you follow the global market portfolio, which we'll label GAA, the all seasons portfolio from Dalio and Tony Robbins, the endowment portfolio from El Arian and David Swinson, they all underperformed the mighty S&P 500. From 2009 to 2023, most asset allocation portfolios had reasonable returns of about 6 to 7% per year. The S&P 500 doubled those returns to 13.9% per year. Again, this 13.9% is slightly lower than the 15%, which was from the exact March 2009 bottom. Adding insult to injury, all the allocations had similar drawdowns and worse Sharpe ratios than US stocks. Volatility was lower, but not in a good way, since most of the volatility for US stocks came from upward, hey, we're getting rich type of volatility. You can actually check the link in the show notes for this entire post, which has charts listed as links to other resources showing the difference, for example, between global asset allocation portfolio returns and the S&P 500 from 2009 to 2023. Still, 6 to 7% returns are respectable. Why then was this such a challenging period for diversification? Let's use the GAA allocation for reference. Despite putting up returns in line with historical averages of almost 4 percentage points above inflation, the allocation underperformed the S&P 500 by over 7 percentage points per year. But that's not the punchline. The globally diversified portfolio didn't just underperform by a significant amount per year, it underperformed nearly every year. And that's a significant distinction. Investors can handle underperforming for a year or two, but the constant struggle crushes morale, causing many to give up. The GAA portfolio underperformed 10 years in a row. Not one, not two, 10. And if we go back further, the GAA portfolio underperformed in 13 of the past 15 years. The only period remotely comparable to this in history was the post-World War II era. No wonder your clients think the game has passed you by. As Charlie Munger once said, the world is not driven by greed, it's driven by envy. Watching your portfolio lose out to a basic ETF like SPY year after year takes a toll. Now, this piece targets US investors, but if you're one of the 95% of humans living outside the United States, diversification worked excellent. That's mainly because you would have invested about half of your stock exposure in US stocks. However, if you rewind to the period from 2000 to 2008, everything looks a lot different. GAA outperformed US stocks, and it did it with lower volatility, lower drawdowns, and a higher Sharpe ratio. Again, you can find visuals and a chart of the GAA allocation and the S&P 500 from 2000 to 2008 in the show note links. And then we also zoom out to the full picture of both since 1973. The problem is deciding when or even if this trend will reverse. This article and Mebisode, for instance, could easily have been produced in 2021 with similar gripes and conclusions. Let's consider the 15% S&P 500 returns for over a decade in the context of history. We mention in this piece a chart of rolling 10-year US stock returns for the past 100 plus years. There's been 4 periods with similar performance. Are these sky-high returns normal? Sure. They fit well within what has happened in history. The other 3 times this happened all have names. The Roaring 20s, the Nifty 50s, the internet bubble, and whatever we're going to call this period, likely the COVID meme stonk era. The problem is eventually the good times end. Unfortunately, those all had names too. After the Roaring 20s came the Great Depression. After the Nifty 50s came the inflationary 70s. And after the internet bubble, of course, we had the bust and the global financial crisis. What comes after the COVID meme stock era? We don't know. Now, none of the above means stocks have to crash. The broad US stock market is expensive, but it's not as ridiculous as it was a few years ago, or even at the peak of the internet bubble. Still, this is a richly valued market. So what's an investor to do? Go all in on SPY, QQQ? Forsake the globally diversified portfolio for the allure of a different boat? If you follow Cambria and our writings, you likely know our answer, which will stay consistent across market cycles. First, you diversify globally using global stocks, global bonds, and global real assets. Next, you implement the allocation with low-cost, tax-efficient ETFs. You then rebalance the portfolio consistently. You then tilt towards factors like value and momentum. And lastly, you add a healthy slug to trend-following strategies too. Are you willing to bet the past 15 years continue? If it does, and you're diversified, you'll still be okay. If not, that might be a problem. 2022 was a good reminder that stocks and bonds don't always go up. What if we have multiple years like that? We're reminded of a quote from the great Sir John Templeton. Diversification is a safety factor that is essential because we should be humble enough to admit we can be wrong, because we never know when or what is coming next. Thanks for listening, friends. Good investing.
Podcast listeners will post show notes to today's conversation at mebfaber.com/podcast. If you love the show, if you hate it, shoot us feedback at themebfabershow.com. We love to read the reviews. Please review us on iTunes and subscribe to the show anywhere good podcasts are found. Thanks for listening, friends, and good investing.